morning everyone. I think you've heard plenty of buy ideas in the earlier sessions already. So this segment is actually a panel discussion where we will be discussing some of the defensive ideas to help you weather through this volatile environment. So even though equities, they have done quite well this year, we cannot deny that the global economy, it is on a much weaker footing compared to the beginning of 2022. If you look at major economies like the US, UK, and much of Europe, inflation rates are still well above their target rates. And on top of that, China's economic recovery is also stalling, dragging down the regional outlook, especially for its export-oriented neighbors such as South Korea and Taiwan, just to name a few. Meanwhile, central banks across the world have been hiking rates aggressively. So in the US alone, rates have gone up by 500 basis points already. And the yield curve is also displaying one of the deepest inversions that we have seen since the 1980s, and recession fears are of course plenty. And during times like this, I think many investors like you and I are also thinking of ways to recession-proof our portfolios. So today, each of our three panelists will be sharing one idea on what you can do to recession-proof your portfolios. So I think we'll start with you, Chloe. So in a recessionary environment, I think one of the defensive sectors that people think about when they think about defensive names is the healthcare sector. So why is this the case?
So unlike other sectors, the healthcare sector actually benefits from this relatively inelastic demand for healthcare services, regardless of the economic climate. And if you think about this actually makes a lot of sense, as when most people are sick, they need to visit a doctor or need medication, and this is not something that can be delayed or something that people are very price sensitive to. And because of this inelasticity of demand, the earnings for the healthcare sector also tend to be better protected, and they demonstrate less severe downside, especially in times of softening economic growth. And to add on, I also want to share that we note that the performance for the healthcare sector, it has historically outperformed during periods of market downturns or sell downs, and such attributes would make them an attractive target for investors who are looking for assets that can better able to weather a potential downturn. And not to mention, I think a factor going forward is that global demographics, they will continue to support the healthcare sector's growth in different ways over the longer term. In developed markets, for instance, you will see that an aging population will require more treatments. And in emerging markets, for instance, faster population growth is fueling the demand for more healthcare products and services as societies become wealthier and the middle class also grows.
Right, so I think you've shared quite a lot on the defensive attributes of the healthcare sector already. So what I would like to know is, are there any growth opportunities in the healthcare sector, perhaps any sectors or areas that can deliver longer term growth?
Yeah, of course. So I think like what many of you said just now, I think many people attribute the healthcare sector to often having these defensive attributes, but the sector does possess some form of growth potential, and a lot of this actually comes from its ability to deliver significant innovation to its patients. So you see the ongoing advances in the development of understanding of new diseases as well as new treatments. They are some of the growth drivers going forward. And if you can see in this chart over here, over the recent years, the number of FDA approved novel drug treatments, they have remained robust. And to actually further encourage more research and development within this space, the regulators have actually helped to accelerate and create new pathways to accelerate the whole review process of the medicines that target high unmet medical needs. And the availability of all these new drugs and new treatments going forward means that it also brings much more options for patients and also brings more monetization opportunities for the companies that are involved. So I want to highlight an area that has been experiencing some form of great innovation, and this is the area of obesity. So drug innovations that are helping individuals manage their weight are the new example of innovative developments that raise hope for blockbuster treatment that can tackle this whole global obesity endemic. And this is a market that is growing rapidly. So I think Bloomberg expects that this market is expected to reach about 44 billion by 2030, and this has grown significantly. If you think that in 2022, this market is only worth 2.5 billion. And not to mention, I think all these medications, they are very important, as they come at a point of time where obesity is the most prevalent chronic condition. And there's also an acknowledgement out there that many people are unable to lose significant amount of weight just through diet and exercise alone. And so thus may be in need of this form of treatment. And treating obesity is important, as oftentimes it can lead to a number of more serious as well as potentially life-threatening conditions such as your type 2 diabetes or even your heart disease. And where it stands within this whole anti-obesity market, we see two players coming up. This is Novo Nordisk as well as Eli Lilly, and they are vying for leadership within this market for anti-obesity drugs. And their respective experimental drugs and pills have led to a 15% and a 24% decline in weight loss respectively. So naturally, I think investors who do want to take part in the growth of the global healthcare sector should consider the iShares Global Healthcare ETF. And this is an ETF that provides a global exposure to pharmaceuticals as well as managed healthcare or biotech and medical device companies across the world. And on the other hand, if you do want to take perhaps an active approach, do consider the BlackRock World Health Science Fund. And this is a fund that invests in the global healthcare sector through an active approach, as oftentimes when you're trying to invest in a specialized as well as a fragmented sector like the healthcare sector, having this active approach can be beneficial to actually gain exposure to good quality companies. So all in all, with global economic challenges ahead as well as much uncertainty ahead, we believe that all these defensive characteristics of the healthcare sector, and not to mention the solid organic growth opportunities that come from this innovation, should actually provide some form of outperformance against the broader market.
Right, thanks, Chloe. So, ladies and gentlemen, I think the healthcare sector isn't really as boring as we thought. So, aside from its defensive attributes, the healthcare sector also possesses many growth opportunities, such as areas like in obesity medications, for instance. So now, I think we can move on to Cyrus. So, Chloe has shared quite a bit on the healthcare sector already. So, Cyrus, do you also have a sector pick to tide through a recession?
Hi, thanks for coming today. So for me, when I look at a recession, right, when I think about a recession, some words come to mind. So it's words like your stability, your resilience, so on and so forth. And when it comes to these type of words, if we focus on US markets, for me, I think the pick is likely to be the consumer staples sector. It should definitely be on top of your radar. And one reason, we'll give a few reasons for that. So the first reason is on margins, and what we notice about it is that gross margins for the consumer staples sector has remained relatively stable over time. So you can see from this chart, 10-year history of margins. Now, average gross margin of the sectors differ between sectors because of structural differences. But what I want you to focus on is actually on the y-axis, which is margin stability or the standard deviation of gross margins. And one thing we notice is that the consumer staples sector has one of the more stable gross margins. It's relatively low on the y-axis over the past 10 years. And this is actually true even if we break down the consumer staples sector into its constituent industries, which are all in blue color, as you can see from this chart. And on top of that, there was some gross margins, and we can see that consumer staples sector generally has gross margins. Now, what about earnings? So what we did in these two tables is actually we looked at earnings in the past 4 recessions defined by NBER, which is the National Bureau of Economic Research in the US. So we look at 2 types of earnings. The left-hand table shows the contraction of actual EPS earnings. And the right-hand table shows the contraction of estimated consensus EPS. And looking at the average columns on the right-hand side of both charts, or both tables, I think 2 sectors really stand out to us. And these are your healthcare and consumer staples sector. So healthcare, Chloe has already talked about it quite extensively just now. But I think it's very clear that the consumer staples sector during a recession does pretty well in terms of earnings during a recession. And if you look at this chart, I think this really underlines the case for consumer staples even more. So what we did here is we looked at forward earnings over the past, since 1990, over the past 30 years or so. And we can see that out of the past 32 years, from FY91 to FY22, forward earnings for the consumer staples sector only fell 3 out of the 32 years. And we think that this 3 years out of 32 really underlines the resilience of earnings for the consumer staples sector. So far we have looked at gross margins, we have looked at earnings. So what about performance? So we do a very similar table here, And instead, now we look at consumer staples sector performance both before as well as after a recession. And I think, again, it's very clear from the table that the consumer staples stands out for its performance both before and after a recession. And this, again, is alongside the healthcare as well, but consumer staples has done pretty well as well. And overall, I think through the past few slides, I think it's very clear that the consumer staples sector stands out quite a bit. It has a history of stable margins, it has resilient earnings, its performance has held up pretty well both before and after a recession. And looking ahead, actually, we think that investors can continue to expect this type of trends ahead, especially with demand remaining relatively resilient so far. A lot of your consumer staples products are they're essentials, right? So we see from a lot of company reports that revenues have remained quite supported so far. And on the cost side, if we look at a lot of earnings results, companies are reporting a moderation of cost side inflation as well. So overall, I think all these, what we've seen with margins, earnings, and performance can persist even ahead as we look into a recession.
So Cyrus, how would you go about investing in the consumer staples sector? Are there any products that you have in mind? And also, when it comes to the individual stocks, what are some things that investors should be looking out for when they analyze consumer staples companies?
Yeah, so I think if we are looking to invest in the consumer staples sector, there are two main ways. So I think the first sort of quick and easy way, right, is to look for a diversified fund or ETF. So by diversified, what we mean is that it should cover these three main industry groups on the slide there. So the first industry group is staples distribution. So as the name suggests, it does distribution. These are your Costco's, these are your Walmart's. Think of mainly your main supermarkets in the US. For the second industry is household and personal products. So these are your Procter & Gamble. So Procter & Gamble, for instance, does your Dove, does your Pantene, your shampoo lah. And these, again, are products that are essential for our daily lives. Third industry is your food, beverage, and tobacco. So these are your Coca-Cola, PepsiCo, Mondelez. So these again sell your foods and beverages. And overall, if you're looking for a diversified fund or ETF, what I'll be looking for is diversification. That is the keyword, diversification. So that was on what to do if you want to look at a fund or ETF. But what if you want to look at a single stock name? So for single stock names, I have two tips for you, two guidelines. First is that the trend is your friend. And in other words, what we should look out for is actually beneficiaries of ongoing trends. And actually one trend we observe, starting from the pandemic, the COVID era, is the prevalence of snacking actually. So I think during the pandemic, a lot of us were studying from home, working from home, right? But what you might or might not have noticed is that a lot of people also started snacking from home while they're working from home, of course. And I mean, personally, I can say that I snack from home when I was working from home as well. But more importantly, even today, when we are all back in the office, we are continuing to snack. This trend of snacking has persisted even past COVID. And if you believe that, if you yourself see this trend of snacking going ahead, picking up going forward, I think you can consider, for example, looking at some snacks companies like Mondelez, for instance. So that was on trends. Now, the second tip I have is to look at pricing power. So before I elaborate into this, I will just give maybe a quick thought experiment for you. So what companies come to mind when you think of these two industries, the soft drinks industry as well as the chocolates industry? Coca-Cola, yes. Any others? Well, I think for soft drinks, most of you have thought of Coca-Cola. Some of you might have thought PepsiCo, Pepsi, of course. And for chocolates, you might have thought of your, let's say, your Cadbury, your Hershey, your Toblerone. Well, the good thing is we have it all in this chart here. So we have Coca-Cola, PepsiCo, we have Mondelez, which owns Toblerone and Cadbury, and of course we have Hershey as well. And what we noticed is that for these companies, their products continue to have relatively low elasticities. So what that means is that they can raise their prices without hurting their sales volume too much. Or in other words, in very simple terms, they have pricing power. And this is due to many factors, of course. I think some of the key factors include very strong branding. I mean, Coca-Cola and Pepsi, they are very well known for their beverages. I think everyone knows them whether you invest or not. And as well as their very large market share. Again, looking at Coca-Cola and Pepsi, both of them take about 70–80% of the global carbonated drink industry. And what this means for you is that because of this pricing power, a lot of them, these four companies, have seen very strong organic revenue growth in 1Q23. So you can see that it's all double-digit organic revenue growth, and most of it is actually driven by pricing, which is how much they have increased their prices. And to us, this strong pricing power is very important. It helps to sustain the organic revenue growth of these companies, and is especially good, especially in this current inflationary environment we live in, where companies need the ability to raise their prices to keep their margins supported. Yeah, so overall, I've looked at quite a number of topics. I think overall, to summarize, if there are two ways of investing in the consumer staple sector. So first is through a diversified fund or ETF. So for this, our recommendation is the Consumer Staples Select Spider Fund, which is passive ETF with an exposure to 37 US large cap consumer staples. So it's all your global leaders, like what we mentioned earlier about your PepsiCo, Mondelez, Coca-Cola, so on and so forth. All your global leaders are there. And its expense ratio is pretty attractive, 0.1%, very relatively low, and it has a distribution yield pre-tax of about 2.5%. So again, for the ETF fund segment, we recommend diversification, and this is our recommendation. Second option was to look at individual stock names. So for this, we have identified PepsiCo and Mondelez. So we think that for individual stock names, again, we want to look at beneficiaries of ongoing trends like snacking. So PepsiCo has your Lay's potato chips, Mondelez has a lot of your chocolates as well. So these are beneficiaries of ongoing trends. And they also have a very strong pricing power, as we saw in the slide before. These companies, we think, can do pretty well in this recessionary environment. So I think that's all for me today. Hopefully I've given you all some food for thought to prepare your portfolio for a recession. Look forward to any questions you have at the booths outside, and maybe you'll find me snacking outside. Thank you.
Okay, thanks, 𝗪𝘆. I think to sum things up, you've mentioned quite a few points already. So I'll do my best to summarize some of the things you mentioned. So companies in the consumer staple sector, they should possess two main qualities. One is stability, the other is resilience. So stability in terms of stable margins, and also resilience in terms of resilient earnings, especially during a recession. And also plus points for companies that benefit from ongoing trends and companies that possess pricing power. Right? So I think we've heard two great ideas from the equity space already, but an investment playbook on a recession, it would not be complete without a discussion on bonds, especially when bond yields have never been this high for so long already. So historically, long duration bonds, they tend to outperform in a recession. So 𝗪𝘆, my question to you is, with inflation still running high, do you think bonds are still able to serve their intended purpose?
I think yes, definitely. I think bonds, they are still able to serve their intended purpose in a recession. So on my chart over here, with central banks hiking interest rates at the fastest pace in decades, you can also see that bond yields across the maturity spectrum has increased to levels that we haven't seen since 2008. And with more than 1 year into this rate hike cycle, I think it's really hard to ignore the fact that income is finally back in fixed income. So what this means is that fixed income now offers improved opportunities for income generation and can also provide investors with a greater margin of safety. So for investors who do include bonds into your portfolios, I believe that you should be able to enhance your risk-reward ratio. While the attractiveness of bonds is indeed increasing, I do also want to mention that it still remains very important for us to manage our duration risk. Even though recession models, they are currently flashing red, the Fed had signaled for even more rate hikes by the end of this year and has also pushed back expectations of a rate cut. And this is because inflation in the US, it is running high and it's also sticky. So if you recall the CPI figures for the month of May, the headline inflation was at about 5.3%, and that was actually even higher than the core inflation was about 5.3%, and that's even higher than the headline inflation of 4%. And besides that, history has also shown that once inflation breaks above the 5% mark, it will usually take years for inflation to get back down to the 2% central bank target. So under such circumstances, for us, we will continue to prefer short duration bonds. Short duration bonds, they are less sensitive to the interest rates changes, and they can also allow investors to lock in attractive yields without taking on greater duration risk. And based on the chart that you can see on the screen here, it's pretty clear that short-term bond yields, they have moved up a lot higher as compared to the long-term bond yields. And for the yield curve, it also remains deeply inverted since short-term yields, they are now a lot higher as compared to the long-term bond yields. And in my view, I think that investors, they will increasingly ask for greater compensation to hold the longer dated bonds given high inflation as well as record debt levels. So even though the US debt ceiling crisis, it is now behind us, For now, I think that investors will ask more compensation to hold the longer dated treasuries, given the risk of another future breach of the debt ceiling. I think the 10-year treasury yield could stay elevated in the near term, and it can go beyond 4%. And at that point in time, that would be a more attractive entry point for investors to consider adding some duration into their portfolios.
So 𝗲𝘃, I think you've mentioned that bond yields have risen in both the investment grade and also the high yield space. So where do you see more value in, and what are your reasons?
I think it's pretty clear that high yield bonds, they do offer very attractive income, but I think that a more defensive positioning, it is more important in a recessionary environment. And you can actually take a look at the yield premium between high yield bonds as well as IG bonds. And you can see from there that IG bonds, they are offering much more value compared to the high yield bonds. So this yield premium, which is the yield spread high yield bonds have over IG bonds, it is below the long-term average, and it's also far from past recessionary levels. And ideally, investors should be getting a higher yield premium on high yield bonds, given the greater credit as well as default risk as the macro backdrop weakens. So for us, we prefer to stay higher up in quality. We prefer IG over high yield, as investors are still able to capture the higher yields from fixed income by staying within the safer IG segments. But for investors who still want to retain some exposure to high yield bonds, I think that you should adopt a more tactical strategy by going for high quality high yield rather than chasing yields from the lower quality companies which are more likely to default. And by high quality high yield, I'm referring to bonds with a credit rating in the BB segment. And meanwhile, for investors who are happy to stay within IG, I think you will be able to receive rather attractive yields of about 4 to 5%. And to give you some color, some of our recommended funds on our platform, such as the 𝗪𝘃 Shenton Short-Term Bond Fund and the United SGD Bond Fund, they are very viable options, providing yields of about 4 to 5%. So for the United SGD Fund, it seeks to beat the Sing dollar deposit rates and also aims to provide higher yields compared to most of the money market funds. And whereas for the 𝗪𝘃 Shenton Short-Term Bond Fund, it mainly invests in a diversified portfolio of good quality short-term bonds as well as money market instruments. And I do have to say that for this 𝗪𝘃 fund, it has a very attractive yield to maturity of slightly above 5%, and also with a high credit quality of A-. And for us, we do like short duration bonds, and both of these funds have relatively short durations of about 1.1 to 1.2 years. And with that, I hope that you have gained some insights about some of the opportunities in fixed income in a recessionary environment.
Yeah, I guess for the longest time, there was no alternative to equities, but with such compelling yields coming from the fixed income space, I guess it's safe to say that bonds are indeed back. All right, so thank you 𝗲𝘃, Chloe, and 𝗪𝘆 for sharing your ideas. Before we wrap things up, here's a summary of the items that have been discussed. So in terms of asset allocation, we do have a preference for fixed income over equities. Like 𝗲𝘃 mentioned, we particularly like the higher quality bond space and also shorter duration bonds. So as the recession looms, we do prefer higher quality, as a more defensive positioning may be warranted. And also for short duration bonds, short-term bond yields have risen significantly compared to their longer duration counterparts, and this also allows investors to receive greater yields without having to take on higher duration risk. And as for equities, we like sectors like healthcare and also consumer staples as we head towards a recession. And the reason is not only do these sectors, they possess defensive attributes, but such as stable margins and also resilient earnings. But on top of that, they also have certain sectors that have the potential to deliver longer term growth. So ladies and gentlemen, I hope that this session has been useful to you. You have managed to gain some interesting insights on how to recession-proof your portfolios. Thank you for listening, and please enjoy the rest of your day.